This is a fairly informative piece by Michael Hartnett, is that he senses, it smells like we're going towards a bubble moment in these markets. I've just given you the AI frenzy narrative. Take a breath and contextualize whether you think that there is the hallmarks of bubble in these markets, or can it continue given the narrative that AI will help us and earnings will rally?
So great to be on with you. Look, I actually don't think of this as a bubble at the moment. You know, this market is backed up by strong economic growth. Earnings growth is positive. So unless you're really starting to see valuations move up, which are not backed up by that progression in earnings, I don't think we can consider it as a bubble. There are, of course, a lot of comparisons to be made in terms of how expensive the market is for tech, but even from that perspective, I don't think that this is a fair comparison to the tech bubble, because you're seeing that these companies are really backed up by very strong earnings growth. Their balance sheets are very strong. So in a way, as he said, it's only if you start to see a negative payrolls print, if you start to see recession concerns starting to bubble up, then we'd have some concerns. But at this stage, I actually think that this rally, fine, it's vulnerable to a slight pullback, but I think it can keep going through to the end of the year.
Seema, so does that mean we get to a world where bad news is bad news for equities? Because for much of the past, I don't know, it feels like a century, Seema, but I know it hasn't. But every time we get a piece of bad economic news, it fuels another leg higher in equities because we think, oh, great, we're going to get cuts. So are you saying that that will shift at some point?
I think it will shift at some point. I mean, I think the one thing that we are starting to hear is people are starting to split the idea of economic growth impacting inflation. So there's this idea growing that the economy can grow fairly well around trend growth without necessarily reinflating those inflation pressures. If that is the case, then yes, we're going to go back to a point where the bad news is bad news. But I think we're still a little bit further to go for that.
We heard a lot yesterday from two core central bankers, one from Lagarde, who undid a lot of the dovishness that came into the market when they when they lowered the inflation outlook, and obviously downgraded the growth outlook. But she was at pains to say, we're moving from a holding season to restrictiveness to normalization. And we need to be careful not to commit to the rhythm, the magnitude, or the time. Loretta Mester yesterday talks about the mistake that would be made of moving too quickly. Do you think the divorce in markets is now, the assumption is that we go in some kind of synchronized cutting fashion, but really the narrative from Powell and from Lagarde was this is not going to be a lockstep cutting as you've seen before?
Absolutely. So look, they've got the benefit of history for them to learn from. And those historic lessons are that, you want to tread very carefully at this point. If economic growth does reaccelerate and we haven't seen that split between growth and inflation, well, then the risk is always going to be there that price pressures take off again. So from my perspective, for the Fed, certainly once they start cutting rates, they will go fairly cautiously, not necessarily doing back-to-back cuts, because they need to cut and then see what the impact on inflation is. The ECB and the Bank of England, actually, for that matter, are quite different in that their economies are already struggling. Near stagnation, the UK in recession. So once those central banks start to get going, and they will take a little bit of time because they have got that cautiousness with regards to seeing sustained disinflationary pressures. But once they start to get going, we are expecting them to move with greater urgency than the Fed and probably have a more extended rate cutting cycle than what we're going to see in the US.
It is interesting to hear Lagarde be more reserved than Powell. The language seems like it continues to change. Actually, maybe that's not quite accurate. What it seems to be is that Powell comes out and endorses cuts at some point and is more dovish on that front. And then you get this whole host of other speakers who say, wait a minute, we're not as confident. And they don't sound as confident as Powell. What do you make of that back and forth? Because Powell had the opportunity in front of Congress to sound more reserved, and he didn't. He said, we're near that confidence for cutting rates.
Yeah, Danny, that's a really good point, because actually this isn't unusual. For the last couple of months, that has been the trend of a very volatile communication policy from the Fed, of one message from Powell and then it almost being walked back by other Fed speakers. So it was a little bit surprising. And actually, if you can do that comparison with the ECB, I think the one thing that Lagarde has got quite right is that her messaging has been very consistent. It's been very clear. And I think everyone is quite clear on what the message from yesterday was, which is that, look, they're leaning towards June rate cuts, but they're very data dependent, and they want to see how wage growth pans out. Whereas from the Fed, I don't think that we have that amount of clarity, which, as I said, it's been fairly typical. I wouldn't be surprised that over the coming weeks we do see another set of Fed speakers coming out and sharing their own perspective, which, of course, unfortunately does add that volatility to the market.
So the risk in the very near term, then, is what, Seema, for markets? We're just showing the euro dollar again trading that little bit lower this morning. Yields, as Danny said, traded to a 1 month low on the back of this hope from Powell. So as you look at markets, we are full risk on. Equities banging out record highs. Yields are turning lower. Just contextualize risk for me at the moment. If you don't believe that we're in a bubble, is now the time that you go for breadth?
So look, I think that over the next couple of weeks, couple of months, there is still that potential for volatility. Because, we're still quite data dependent. We're going from data point to data point. We need to see, of course, what the jobs number is today, but of course, what the inflation numbers. And if they come in slightly hot, then you're going to see the market pulling back their expectations and maybe pushing out that date of the first rate cut, which will add volatility. But we do have some confidence that around the middle of this year, so once you start to look at the trend rather than the month-on-month side, the trend is pointing to continued disinflation, and it's backed up by fairly solid growth, slightly slower, but still solid growth. So from that perspective, if you're able to take more of a 6-month perspective, even a year perspective, this is a fairly risk-on environment. And there's a lot of parts of the market which were quite unloved last year, which have fairly attractive valuations. And we do think that that's where investors should start to focus their portfolios.
Where is that,
so that's
Seema?
not saying to...
Is that small caps?
Yeah.
Is that somewhere on the
You're going to make her day. You're going to make her a week. If you say the word small caps now, you be careful what you
Friday.
say.
I deserve a present.
Danny, I'm going to make your day. I do actually think that small caps have got a lot of potential for this year. I do think that the road for the next couple of months is going to be very rocky, and it's not going to be a straight line up. But once you get to the point where rate cuts are very clearly envisioned, and it's backed up by still positive economic growth, that should really be a green light for small caps. I just want to reiterate here, though, that doesn't necessarily mean that we have a negative view of that mega cap tech space. We do continue to think of that as a long-term, very important part of the portfolio, but it's about thinking about where else is there that you want to deploy your assets. Remember, a lot of retail investors are still sitting in some cash, so there is a lot more to go in terms of where that firepower can come from.